Welcome back to the Dividend Diplomats YouTube channel. You know you've got your favorite dividend broskies here. You've got Bert rocking that Ohio State Buckeye hat. And you know you've got Lanny rocking the V for Vanguard. And we're here to talk to you about three undervalued dividend growth stocks here now that we're in the month of June, baby.
Before we talk about these companies, everybody, please subscribe to our channel. Give this video a thumbs up. And you know what? It's summertime. Looking at that wardrobe, you got to refresh that wardrobe. Check out the Diplomat swag store below there for a t-shirt. I know Lanny and I rock the sweatshirts. We don't even have t-shirts yet, Lanny. Maybe it's time for us to get some Diplomat t-shirts for the summertime.
Hey, if we get to 500 likes on this video, leave a like, drop a comment, and on that 500th, we're going to send out some swag. We'll reach out to you for your, information, and we'll send you guys some swag. So let's get there. Let's go. It is summertime, and we got three dividend stocks here. You know, the S&P 500 was another fun ride this past week because you remember heading into Memorial Day, we were up 6%. Well, guess what? I'm pretty sure, Bert, correct me. You've got to correct me here if I'm wrong. The stock market, again, finished up for the second week in a row, finished up at about 0.76%, maybe.
Yeah, finished at 41.08. There's just a lot of noise once again throughout the week. It was your peaks and valleys, but it all ended up barely increasing there. So highest point 41.80. And then, yeah, ending dropping, shedding nearly 72 points to end the week. You know, the volatility continues. Everyone, investors, analysts, you name it, are out there just trying to figure out what to make of all the inflation news, of all the new jobs numbers and everything, and that increasing price per gallon of gas, too. There's a lot going on.
Yeah, and, the Fed is going to be starting their quantitative tightening, not easing. So they're going to be pulling cash out of the economy, aka taking back what they put out there over 2020 and 2021 because of the pandemic.
Yeah, reduce the cash supply. That's one way to slow down the economy as well. So we'll see what's going to happen once the tightening starts. That being said, regardless of the noise of what's going on in the market, we are always looking to buy undervalued dividend growth stocks. We focus on companies that have increased their dividend through different economic cycles because it withstands the test of time. If they can increase it during the financial crisis, if they can increase that dividend during the dot-com bubble, the savings and loan crisis of the 80s, chances are they can survive some of the short-term blips that are going on here in 2022 and all the unexpected stuff in the future.
Yeah, I couldn't agree more with Bert. It's all about staying invested as well. This is not the first time we've had volatility, not the first time, we've had an increase in interest rates, not the first time we've had inflation, et cetera, et cetera. So I'm very bullish on long term. So if you're bullish on long term, let us know in the comments, because that's what this investing channel is all about, is buying dividend growth stocks over the long term, then using that dividend income as a great source of passive income, right, Bert?
Absolutely right. And that's what you've done here today. You've prepped your watch list, Lanny. You've done some research. You typed some words into the computer. You found some tickers in there that have piqued your interest here. And you found them using the Dividend Diplomats Dividend Stock Screener. Three simple metrics: PE ratio less than the S&P 500, payout ratio less than 60%, history of increasing that dividend, where we look at the 5-year average dividend growth rate and how many consecutive years a company has increased that dividend. And then we throw that bonus cherry on top where we look at a company's dividend yield.
And guys, these may not be the sexiest stocks that we're talking about here on the channel. And no, we're not talking about ETFs or mutual funds. I know you guys know I'm a huge believer in Vanguard's S&P 500 VOO, which I do still buy every single day, $50. And then, buying VYM, the high dividend yield ETF, buying each Monday. But we're here to talk about three individual stocks. Guys, these are three stocks that I actually own in my portfolio, and I actually own a lot of, but I'm starting to, see some value out there. Three stocks that I kind of wanted to, continue adding, because I've seen, a little bit of a again, kind of industry based as well as yield based that can really help push up that dividend income in a safe way.
I love it. Avoiding adding new positions. I've been all about that so far in 2022. So this first company, Lanny, you said these companies aren't sexy, but you know what? This first one sure is delicious. Why don't you talk to us about this first company and share them and the products that they make?
Hey, bro, you take it easy there. Because so if everybody doesn't know, yes, I am Italian. Shocker right
No,
there.
no.
Uh, so this first company that we're talking about here today, I hold dear to my heart because it brings it home every Sunday for pasta night, guys. We're talking ARMNF Foods of distinction, ticker symbol AMNF. And this is definitely a smaller company. And, they make products that you see that they use in restaurants that you can buy in your local freezer department or even on your shelf. They make, your Parmesan cheese, your pesto, meatballs, your pastas, ravioli, you name it. They've got that nice flavor to what they do. And they're also a fun dividend stock to own.
Yeah, you're going to see the metrics and you're going to love them. I do love how it's of distinction in the stock name. It's like Ohio State. They have the Ohio State. It's Armanino of distinction.
Of distinction. Very, very much, the
Don't you
blood, sweat, and tears.
don't you forget it. All right, let's look at the PE ratio here to see the metrics behind them. Price close as of June 3rd, $3.54. Forward EPS 18 cents per share, PE ratio 19.54. That's below the S&P 500 if you ask me.
Slightly below the S&P 500. And, when I was looking at them again, when they pop back up on my radar, because, again, they only trade at $3.54. So to give you a quick little snapshot of how many shares, I own over 800 shares of this company. And that's going to seem like a lot. And again, it's not that large of a position. But at one point, about a week or 2 weeks ago, and I wasn't able to capture it then, they were trading the $3.20 to $3.30 range, which you'll see on a purchase video later this week. I was actually able to buy more shares in the $3.43 range. So yeah, they finished up for $3.54. So they're already up 10% from when I was like really anxious to get back and buying more shares of them. So yeah, PE ratio less than 20. That second metric is that payout ratio. And again, the earnings that Bert just said, 18 cents, is really annualizing their first quarter results. Because newsflash, not many analysts are reporting on Armanino food stock. So they pay a 3-cent per share per quarter dividend, or 12 cents a year. The payout ratio is about 66%.
Excellent. So just a hair above our threshold, but you know what? It's a threshold. We keep an eye on it. 66%, not that much higher. It just makes you make sure earnings aren't going to come down. Just something to watch. But you know what? It's not 100%. It's not 90%. It's not 80%. Overall, not at levels that should be overly concerning from a dividend safety standpoint. Let's talk about dividend history here. That 5-year dividend growth rate is 9.85%. They've increased that dividend for 1 consecutive years. They held it firm there for a little bit during the pandemic. Restaurants are a big part of their business, so they hung tight. They paused the dividend increases, and they're bringing them back here last year. They're back to 1.
And they actually started using a lot of their savings from increasing and holding the dividend where it was to actually pay off their entire debt. And that's actually a very reasonable and prudent approach by management to clean up the balance sheet.
And they were oddly transparent about it too. That was the fun thing about them. They had no problem telling you that's what they were doing.
And that's why I really like Armanino Foods, especially as we get into more volatility, rising interest rates. They don't really have to worry about that too much. So again, the dividend yield at the time of this video is 3.39%. Again, if you were to talk to me about a week or 2 weeks ago, they were much higher than that. But again, more than double the S&P 500, more than a high yield savings at Ally at 0.75, at SoFi 1.25. Again, overall, fairly solid dividend metrics, PE below 20, payout ratio 66%, dividend growth rate is over 9%, and a yield that is reaching 3.3, 3.4%. Now, Bert, well, how are they performed in the last year and year to date?
Awfully. No, I'm kidding. They actually performed very well. They're outperforming the market. They're up 7.27% year to date, up 8.92% over the last 52 weeks, beating the market. Still undervalued compared to the market. Interesting right there.
All right, guys, let's go into that second dividend stock. Again, because of you guys out there in the community, I was able to get and push myself over to the 200 share count of STOR Capital, ticker symbol STOR. And yes, Warren Buffett did slim down his position on STOR Capital. Come on, Warren. Missing out on this nice dividend yield over here.
Yeah, you know what? Or you can think of it this way: it helped because it's going to make it a little bit more undervalued for you, Lanny. Because there's a nice little sell-off when Grandpa Buffett leaves town. That's for sure.
Yeah, that's why it's back on the watch list, because it's now, raising rates, rising interest rate environment usually, impacts them from an interest expense standpoint since they borrow, buy properties. So it's going to impact them in that way.
But even though Buffett slimmed down his position there, he's still a shareholder. But also that doesn't change anything about the company, the tenants they lease to their core business there. So you know what? Why not look to take advantage of them potentially, especially if their metrics are looking great through our stock screener. Do you want to look at that first metric here, Lanny?
All right. Yeah, that sounds good, Bert. So instead of the price to earnings ratio, we're going to look at the AFFO, or the adjusted funds from operations ratio, because they are a real estate investment trust or a REIT. So you really look at the funds from operations. And so we did just that. They were recently trading at $27.24, annualizing their most recent quarterly AFFO. It looks like $2.28, which is the equivalent of an earnings per share in this analysis. PE ratio, or the AFFO ratio, is below 12, Bert.
Yeah, fantastic. Let's look at that second metric here. $1.54 annual dividend. That gives you a payout ratio of 67%. Fantastic.
Why is that fantastic for a REIT?
Because REITs are required to pay out a huge chunk of their earnings. So obviously with the slight adjustment there for AFFO, they're actually required to pay out at least 90% of their EPS there. So you take the slight translation there, they're only paying out 67% of the FFO. Fantastic stuff right there for STOR Capital.
Yeah, good room to grow. You don't want a high dividend growth rate, high dividend yield stock. That's usually not sustainable. That's why we're getting into this dividend growth metric here. STOR Capital has been juicing up the dividend for over 6 years. They're saying, Warren Buffett, thanks for hanging on, but it's not going to be as big to you as it might be to some other shareholders here when we get that 7th dividend increase here. They've been doing it for about 6%. And Bert, why is 6% a very solid dividend growth rate for this stock?
Well, higher dividend yield, as you said, higher dividend yield, higher dividend growth rate. That's going to be a huge dividend factor right there. Don't want to spoil the bonus metric there, but REIT, you compare it to a company like Realty Income, that blows Realty Income's dividend growth rate out of the water. So it's great that they continue to grow earnings. They continue to grow FFO to a point where they can grow earnings. They can grow the dividend by 6% on an average annual basis.
There it is, guys. And, year to date, they're getting crushed down about 21, 22%. Over the last 52 weeks, getting murdered by about 24%. So this is a dividend REIT that is getting beaten down pretty bad right now.
Yep. So to summarize, price per FFO, 11.95, payout, 67%, 5-year dividend growth rate, 5.86, increase that dividend for 6 consecutive years, the yield of 5.65%. Lanny, tell us about that third company here.
I will. And thank you guys for hanging with us as we dive into these 3 dividend stocks. I know it's a lot of information. We'll try to, go through it in as much detail that's efficient enough for you to take some stuff away here. Guys, we talked about this dividend potential growth stock now, about a week or so ago. This company announced a $5.20 special dividend as well. We're talking Lyondell Basel, ticker symbol LYB. They are back on this dividend stock watch list, and I'm sure it comes to no surprise there.
It shouldn't be, especially if you watched the video, you read your article about it that we recently had here on the blog, Lanny. Yeah, that special dividend's insane. 5% on the special dividend alone with a very strong regular dividend yield right there. Excellent.
And just to kind of tell people why it's back on the watch list, obviously that's great news. I actually already have a large position of LYB, but at the time that they announced the 5.3% dividend increase and the $5.20 special dividend, they're trading around $117, $118. And, to finish off, they're at $107.40 this past Friday after the X date. That's $10 lower than where they were at the announcement. I would have expected them to be about $6 and some change lower, so in that 111 range. So being even below that, I feel like has opened up a little bit of a value opportunity if you haven't been able to buy Lyondell Basel.
Yeah, that makes sense. $5.20 you would have expected to be priced into the price right there. You'd expect it to decrease $5.20, as you said, down over $10 per share. Yeah, there's definitely some value in there right after that special event. It's an excellent point to call out. Let's talk about the metrics here for them, though. Let's run them through the stock screener. First metric, price 107.40. Divide that by their forward EPS of 1665, PE ratio of 6.45. I believe it was what time your video was 7, so now it's even lower. It's 645.
How low can you go? All right, to jump into that second dividend metric, that payout ratio, guys. Again, this is about the safety in the dividend. They currently pay $4.76 broken out over 4 quarters, or now $1.19 per share per quarter. So every share you own, you get $4.76 of Lyondell Basel. That payout ratio is actually only 28.9%, so very low as well.
Yeah, let's look at that metric. Third metric here, dividend history, 5-year dividend growth rate, 5.91%. Increase that dividend for 8 consecutive years. Obviously, that doesn't factor in the big special dividend that was discussed, but those are still excellent metrics here. So, hey, I mean, with a 5.91% dividend growth rate with that low payout ratio, with plenty of room for that special dividend, love it.
Yeah, not bad. And then that dividend yield as a bonus metric, they're trading at a yield of 4.43%. Again, always put it in frame of mind. The S&P 500 is about 1.5% right now. So you're looking at about 3 times the S&P 500. And then your savings accounts, the best one you can get is probably a little bit over 1%. You might be able to find a 20-month CD at 2%. So this is yielding 4.43%. So well above those risk-free products. But the S&P 500, not risk-free, obviously.
So to summarize, PE ratio 6.45, payout ratio 28%, 5-year dividend growth rate 5.91%. Increase that dividend for 8 years with a yield of 4.43%. Lanny, rank them going into this week. What's your 1, 2, 3 on your watch list?
Tell you what, obviously, again, everybody should conduct their own research. A little disclaimer there for you guys. Have to do a little plug there, but from a position standpoint, how you see it, how we did them was probably lowest to largest from a position standpoint. ARMNF is, not to say it's dear to my heart or, I've got so much emotion in on them, but it'd be cool to get them to 1,000 shares. And I'm about 100. Again, you'll have to check out the dividend stock purchase video this Thursday. But I'm a little over 100 shares away from that. So not too much of an investment left. I may have bought more STOR capital just because of the price. I'm like, I might as well either average down my price and grab more yield as well. So probably in that order as we said it here: ARMNF, STOR Capital, Lyondell Basel.
Everyone, let us know in the comment section what you think of these 3 companies. Are you watching or buying any of them? Were you shocked to see ARMNF on here? I know that's one we haven't discussed frequently on this website, but it has made appearances there. And if you haven't already, please subscribe to our channel. Give this video a nice thumbs up. Everybody, we've appreciated the love and support over the years.
Guys, that was Bertha, Hurt, and Lanny from the Dividend Diplomats. Over and out.